Hi, I'm Monk and this is the Monk Way. Let's look at the most common mistake made by beginners in the stock market, thinking the price of a stock determines its value. We'll go over why this is not the case. Understanding this simple concept will help you make more money in the market. Subscribe and hit that bell for more beginner stock market videos. I make them every day to teach you something new, and leave a like if you gain some knowledge. Too often do I find people comparing the price of stocks. Recently in my marijuana stocks video, many commenters would write something like this: Aurora Cannabis is so much cheaper than Canopy Growth because it's $7 compared to $30, or about how Canopy won't double to $60, while Aurora might double to $14. This is a very wrong assumption and could lead you to buy worse companies. We saw Canopy Growth doubling in price to $60 while Aurora went to $8, proving these comments wrong. The price has no bearing at all on how much it can move up, or how much value the company has. It's an arbitrary number that can be as high or low as the company wants it to be. To see why the price of a stock doesn't matter, let's compare two companies, Company A and Company B. Company A has a market capitalization of $100 billion. Market cap just means the combined value of all their stocks, so the total value of that company. They decided to sell 1 billion shares of stocks during their initial public offering. 100 billion divided by 1 billion is $100 per share. Company B is only worth $10 billion, 10 times smaller than Company A, but they decided to sell 100 million shares of stocks. 10 billion divided by 100 million is also $100 per share. Does this mean both companies are equal in value since they're both $100? No, because Company A is worth 10 times as much as Company B in market cap. This is why the price of a stock says nothing about their value. The market cap is the important number when comparing company size. The price of a stock is determined by how many shares of stocks the company decide on. Some companies knows that a smaller price has a psychological effect on new investors. They might wish to split the number of stocks they have. If a company decided to split their stocks into more pieces, let's say by 2, then their stock price is halved. The value of the stock stays exactly the same from $100 to $50, meaning this number is completely meaningless. A $100 stock that makes $100 a year is the same as a $50 stock that makes $50 a year. Canopy Growth was thinking of splitting their stock from $30 to $10. In this situation, the new investor might think they're much cheaper, even though no value has changed. Their price-to-earnings ratio stays the same because even though the price was cut 3 times, their earnings per share is also cut 3 times. This means a company can make their stock price any number they want. If Google wanted to reduce their price to $100, they can do this with a 10 times stock split. Companies might do this to get a bigger looking price, or a smaller looking price. Nothing has changed except the public perception of their stock. Let's use a real-world example to see why price really doesn't matter. Apple recently reached $1 trillion in market cap. Their stock price is only $220, but they have 5 billion shares of stocks. 5 billion times 220 a share is over $1 trillion, making them the biggest company in the world. A beginner might see this $220 and think, this is much cheaper than Google. Google is over $1,000 right now. But using what we learned, we can see Google's market cap is $800 billion, 20% smaller than Apple, while their stock is over 5 times as expensive as Apple. You can see why the stock price is not important when comparing these companies. Google costs more per stock but is worth less than Apple overall. If these two companies made similar amounts of money, their stock price should go up at the same rate, meaning Google might go up 20% in a year, from $1,000 to $1,200. And Apple might go up 20% too, from $220 to $264. Even though they have a big difference per stock, they would go up at the same rate if they had the same amount of value and profits. Don't buy a stock just because it has a lower price than another similar company. The real way to determine value is comparing their price to how much the company made in cash and profits. This is why we have the price-to-earnings ratio and the price-to-sales ratio. Because the price is not an important number, but comparing it to how much they made gives us the real value of a company. For example, if Company A is $100 a share, and they made $100 per share in a year, this is a return of 100% a year. And if Company B is $10 but they only made $1 per share a year, this is a return of 10% a year. If you had $100, which company would you choose? The beginner might buy 10 shares of Company B thinking it's a cheaper stock and having more shares feel better. This would be a mistake because the market can see their earnings of 10% a year and might only raise the stock price by 10% in that year. While Company A, even though they cost 10 times more per stock, is making much more money, and might give you 100% in that year. The beginner might have made 10% on his investment, missing out on 100% in returns with Company A. This means it's better to own 1 share of a good company than 1,000 shares of a lower value company. Amazon just reached $2,000. This might seem expensive, but it doesn't mean it can't keep going up. It's much better to buy 1 share of this than 200 shares of Snapchat at $10. Amazon actually makes money and increases users, while Snapchat loses money every year and has problems keeping users. People tend to think lower priced companies has more room to go up. A common thought is a $10 company is much more likely to double to $20 than a $1,000 company doubling to $2,000. This is not not true either. We saw Amazon going from 1,000 to 2,000 in less than a year, but this might happen more to lower-priced companies because they tend to be high volatile risky stocks, meaning there's more chance of them doubling, but also more chance of them dropping 50% or more. For example, we saw Snapchat move from $10 to $14, then back to $10 in a short time. This isn't because their stock price is low, this is because it's a volatile company without profits. Lower market cap companies tend to have lower stock prices, these companies are more risky in general. A small company worth a few million has more of a chance to double than an old and established company like Google. The next time you see two similar companies, and one is 3 times as expensive, don't assume that means it's costing you more money. If they're making the same amount of money, with similar market caps, it means they will have similar worth. So a $10 company might be worth the exact same as a $30 company. They can both go up at the exact same rate. The only time stock price should matter is if you can't even afford to buy one share of that company. For example, if you're really new and you only have $500, then you can't buy Amazon. In that situation, you should still understand, buying one share of a $500 company might be better than 500 shares of a stock that's $1. Owning a million shares of a dying company doesn't mean anything, but owning one share of a big company like Apple or Amazon means you get a slice of a great company. You must remember, when you buy a stock, you own a piece of that company, so don't buy a stock of a company you wouldn't want to own. Do your research to find the real value of that stock before any purchase. Let's look at another real example to really understand this, and to see how to actually find the value of a company. Intel is a blue chip company everyone knows. They're trading at $48. Nvidia is also a chip maker known by gamers for their graphics cards, trading at $280. Using what we've learned, we can see that so far, we don't know which company is a better value or which is more expensive. Even though Nvidia looks like it's 6 times more expensive, this is not how stocks work. Looking closer at their market cap, the combined worth of all their stocks together, we see Intel is $223 billion, while Nvidia is $170 billion. This means Intel is a bigger company even though they're 5 times cheaper per share of stock, but this still doesn't determine their worth. When buying a stock, we have to compare that market cap to how much they made per year. For example, if Intel made $223 billion last year while having a market cap of $223 billion, they made 100% of their worth in a year. If the market sees this, they might increase the stock by 100% because of this crazy growth. When we look for a stock, we have to look for the one with more growth. A huge spike is usually because a stock made more money than last year, and 100% increase in profits might move a stock up 100% once the numbers are released. In reality, Intel has a PE ratio of 17. This tells us they made $1 for every $17 we're paying. Dividing 1 by 17, we get the percent they made in the past year, 5.9%. This means we can expect them to make 5.9% of their worth back per year, while increasing slowly every year. 5.9% of their $223 billion market cap is $13 billion, so they made $13 billion of profits in the past 12 months. Looking at Nvidia, they have a PE ratio of 41. 1 divided by 41 is a return of only 2.4% a year. This is twice as low as Intel. The price-to-earnings ratio tells us their profits in relation to their market cap. So 2.4% of Nvidia's market cap of $170 billion is $4 billion, meaning Nvidia made $4 billion of profit in the past 12 months. Looking at their income statement, this checks out perfectly. This tells us their real worth. Intel is a better deal because they're making 5.9% a year while Nvidia is making 2.4% a year. But this is not the whole picture. Intel only went up 100% in the past 5 years while Nvidia went up 1,300% in 5 years. This is because Nvidia has been growing much faster. Looking at the revenue growth for 5 years, Intel went up an average of 5% a year. Nvidia went up an average of 33% a year. This means a smaller market cap company might have more chances of extremely high growth. While a blue chip company like Intel is already so big that growth over 5% isn't as likely, even though Intel is a better value, Nvidia could see much bigger returns in the future. When buying a stock, you have to consider both the value and the possibility for growth in the future. Using numbers like their revenue, profit, how much worth is in their company, percent growth, and many more. The price of the stock is the least useful number when it comes to finding the value of a stock. The next time you see two companies, and one has a much higher price, check their market caps. If they're similar in size and are making similar profits and revenue, they're not so different. Help cure ignorance by correcting someone who makes this mistake of caring about a stock's price. A $2,000 company is not expensive, a $10 company is not cheap, remember this. If you learned something today, join my stock market group to learn even more. You'll get instant updates of all my trades with my thoughts on each move. I have a portfolio with over $260,000, with more money added monthly. Some recent winners include Canopy Growth and Aurora Cannabis, 25% each with over $9,000 of profits. If you were in my group just 2 weeks ago, you would have seen the minute I bought those stocks. I'm a conservative investor with a goal of preserving my money while making a good return. So far I've not taken a loss on any trade in the market. Look in the description for a 50% off coupon, only for the first 300 members in the group, and we're almost full. Then it'll be full price for life, so don't miss out. Subscribe and hit that bell for more beginner stock market videos. I make them every day to teach you something new, and leave a like if I taught you something. Keep watching to gain knowledge on stocks, the Monk way.